Boom, what's up you guys? It's Royce Jacob, and welcome back to another members exclusive video. In this one, we're going to be watching a pretty short video called An Opportunity Like This Won't Come Again, Emergency Update. This is by a channel that I've been following for quite a while, and that I found a lot of value in myself. And I found that this value, when I watched it yesterday, really resonated with me and aligned with a lot of what we've been talking about here on the channel, and primarily what we've been talking about in the newsletter over these past few days. Considering the market is scared. Okay, you can see right now, even as like the markets just keep selling off further through the trading day, there's been a lot of volatility, a lot of dipping. Like maybe we're going to bounce back into the green, maybe the bulls are going to prevail. But overall, you can tell that the sentiment is truly fear driven. A lot of these rallies turn out to be faux rallies or false rallies that just get eaten up by sell orders, and a lot of assuming large funds too are probably loading up with puts just because they are fearful of others being fearful as well. And this video, I think, just sheds some light, acts as a silver lining, and explains why a lot of what's going on right now is likely just a blip, and is in fact a correction and not a greater pullback or crash. Of course, it is always possible that things get worse than this. Okay, when people are fearful, it's like crazy things can happen. Okay, right? When people act out of emotion, and when that emotion doesn't have reason to leave. So if we weren't to get a piece of positive fundamental news on the short term time horizon, then it's very possible that things just continue in this direction. Okay, again, general physics. Things are going to continue in one direction unless acted upon by an outside force. That applies to the markets as well. Okay, so we're going to watch this. I'm going to try to not interrupt as much as possible. I'll chime in if super necessary, but overall, we're just going to watch a 6.5 minute video. You guys can absolutely just go check this video out for yourself and come back at the end for just a little recap, I guess. But overall, we're going to watch this video. Go grab a little bit of coffee, tea, kratom, whatever you may prefer, and let's watch this video. I also want to say before we get into this, let's go to the very beginning, of course. Have this nice and loud for you guys. I want to say that just give my 2 cents about the tariff, the reason the markets are selling off right now. The primary reason, what the headlines have been reading every single day, Trump's the tariffs are being enacted primarily on Canada and Mexico. Okay, the border tariffs. And I just want to say that personally, I think that this is kind of just a big chested chicken move from Trump. In his book, The Art of the Deal, he talks about kind of the exact strategy that he's kind of implemented, which is what I think he's doing now. He's implemented it in the past before in other kind of weird ways. But it's where it's general haggling in a sense, right? You highball and like, okay, I'll give you this for $100, and they say with the idea that you'd be perfectly fine taking 75, $80, and they're like, oh shoot, I only have 50, and then you say, I'll give it to you for 75, 80, okay, because I'm feeling generous. And that's just the very 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 generalized sense of what I think Trump is doing. I think Trump just wants some of these Canada and Mexico in this case to bend the knee and really cater to the requests of the U.S., which I've no issue with personally. Bad for the markets right now, but overall, I do think that this passes. I don't think that I think that agreements are reached. I don't think these crazy heavy tariffs are going to stick. And although this is very speculative, again, a lot of trading is speculative using the data set you have available to make the most rational conclusion possible. And I just want to share that. That's my general 2 cents. I'll just play this video. Cheers with whatever drink you ended up grabbing.
Something just happened on the US stock market that hasn't occurred since June of 2022, and before that, March of 2020. The Federal Reserve's GDP forecast has just turned negative for the first time in 3 years.
Let's do that.
This is the Fed's model that aims to measure economic activity in real time. After staying at around 2 to 3% over the course of 2025, the Fed's GDP Now forecast is dropped down to negative 3%, suggesting that we're currently experiencing a steep economic contraction. And when we look at the historical data of this GDP model, We see it successfully predicted that GDP growth was going to stay positive throughout 2023 and 2024, despite many economists predicting that a recession was going to happen over this time period. Now, this same model is saying that GDP growth in the United States is turning negative. Now, as we can see on this chart going back to 2012, we've only seen 3 negative readings on this GDP model before. That was once in the second quarter of 2022 and in Q1 and Q2 of 2020. Now, when we look at the S&P 500 index, we know that these readings occurred when the stock market was about 20% off its all-time high. Recently,
that's
we've
a
seen the
good.
stock market
This indicator is
decline by
good.
around
That's a
5%,
good sign.
but we're
What
very
you just
far
explained
off from
there.
experiencing a 20% decline. So the question now is whether this is a generational buying opportunity just like in 2020 and in 2022, or whether what we're experiencing is a lot different and actually signaling the beginning of a substantial correction in stocks as the US economy enters a recession. Now, indeed, this correction that we've had on the S&P 500 more recently has been so far very different to most of the corrections that we've experienced over the last couple of years. When we overlay a chart of US Treasury bonds, we see that they've actually been rising during this recent correction. The vast majority of the corrections that we've seen since 2022 have occurred with Treasury bonds falling,
It's also a weird
not rising.
inverse
When
correlation.
stocks are falling with Treasury bonds falling as well, that's called an inflationary environment. When stocks are falling with Treasury bonds rising, that's called a recessionary environment. The big stock market crash of 2020 that occurred as a result of the pandemic, for example, was accompanied with rising Treasury bond prices, and indeed the economy was experiencing a recession during that period. Bearish investors today will argue that Treasury bonds have plenty of room to rise from here, and stocks have plenty of room to decline as financial markets price in a recession. Indeed, if we really are heading into a recession, the average S&P 500 drawdown you experience during a recession is 30%, which could hypothetically take the market back down all the way to 4,400 points. But rest assured, this is not what we're expecting right now. The stock market can experience what's called short-term growth scares, and these can often happen outside of a real economic recession. We have a great example of that in August of 2024. This was a temporary growth scare. We can see Treasury bonds during this correction were also rising, just like today, and that proved to be a perfect buy the dip opportunity to ride the stock market for another leg higher. So how can we tell if this is just a temporary growth scare? Well, zooming out to 1982, if we look at what's happened in the last 5 real economic recessions, we've seen what's called initial jobless claims in the United States arise heading into these downturns. Or in other words, layoffs were beginning to pick up before the downturns occurred. And of course, these layoffs accelerated during the actual downturn. When we look at what initial jobless claims are doing to date, they've been pretty steady over the last couple of years, not really suggesting that we're seeing layoffs pick up. But there is one more piece of data that's not suggesting that that's the direction that we're heading in. And that can be found on a survey of economic activity called the ISM PMI. This survey shows us the number of new orders that are being made in the manufacturing sector. And as you can see, that's been picking up recently. Now, of course, this is just one survey and is not enough to conclude that the economy is strong. So we can actually add 3 more similar surveys on manufacturing new orders that are conducted by the Federal Reserve itself that are all showing signs of a pickup in economic activity. And going back to 2009, we've really only seen this 4 times before. Once in August of 2009, recovering from the financial crisis, in September of 2013, recovering from the European debt crisis, in September of 2016, in November of 2020, and now we're seeing the same thing today. If we look at what happened to the S&P 500 following all of these instances, it performed extremely well in all 4 cases. As manufacturing new orders picked up, it was a sign of economic strength, pushing S&P 500 earnings higher and so pushing the stock market index higher as well. In fact, when you look at what happens to the PMI heading into and during economic recessions, it goes down and definitely doesn't show signs of turning back up. So we don't think that this recent pullback on the S&P 500 is a sign that we're heading into a recession. We think although there could be a little bit more volatility in the short term, this could actually prove to be a huge buying opportunity for US stocks as stock market earnings see yet another thrust higher against all expectations. In fact, we happen to think that this stock market rally is no different to the one that we experienced in the late 1990s, in the 1980s right before the Black Monday crash, and the one that occurred in the 1920s. Each of these rallies have incredibly similar characteristics that pushed the US stock market into a euphoric rally early. Right now, that's how we're positioned at Bravos Research. We've taken advantage of this dip to increase our positioning on US stocks, and we'll be doing that even further if stocks pull back further.
Okay. So that, I mean, if you've been tuning into the newsletters and stuff, you'd know that I share a similar sentiment. We were loaded up with puts. And in the Waves portfolio, we a very solid chunk, I would say close to half of the profits, maybe even more actually, that we've seen in 2025, like some of these life-changing trades that we've made so far this year, have been attributed to puts. And I have skewed bearish over the past couple of months. And I have thoughts that the markets were overinflated, and that paid off because we saw some very, very meaningful corrections, primarily in those really bubbly, those really overhyped areas of the market. Palantir obviously being the primary one that comes to mind. But as you know, been sharking up. Bitcoin miners just established a new Robinhood call options position. Silver looking good. Like a lot of the plays within the portfolio, I don't want to say are recessionary proof because they're definitely not. But I will say that even if the greater markets do continue to fall, and again, in the short term, who knows, that the next week or two, which in the grand scheme of things is really not a whole lot of time, the next week or two could look pretty bloody. Things could get worse, but overall, I do think that especially with like the Fed meeting coming up a little later this month, we have some more small cap earnings rolling through. I think that the Waves portfolio is very, very well positioned. Even if the greater markets, talking the S&P 500 and NASDAQ, Dow, do continue to struggle, there will always be diamonds in the rough. Capital will always want to be put to work. And with everything that was just discussed and even the tariffs and stuff, that's the argument I've been making for Bitcoin. Bitcoin should actually be thriving in this environment. And I think once the dust settles, I really think Bitcoin miners, crypto stocks, and some of these growth stocks that really saw those major corrections, those 35, 40% pullbacks like Palantir, like Robinhood, will continue to thrive through the remainder of the spring, maybe summer, and possibly even pick up more steam into the fall and winter months. So I'm an optimist. I'm hoping for the best, and the portfolio is ready. So let's keep this momentum alive. Let's ride, and I appreciate you guys watching. Till next time, always remember, take action, make waves. Peace.